All right, why don't we go ahead and get started? So if anyone wants to follow us on Instagram, you can do that, which is good. So we're trying to get 300 followers, and we have 235, so we're almost there. So yeah, if you want to follow us on Instagram, we'd appreciate it. And that's, of course, the podcast. So quick introduction. My name is Mark LaMonica. I look after the individual investor team here in Australia for Morningstar. And today we're going to talk about ESG. And we're going to take a little bit of a different approach on ESG today, one in which minutes before this, Shawnee called me an old man. Yeah, you get to hear about that. So a couple of housekeeping items first. Anything you hear today is general advice. I don't know anything about you, so I can't offer you personal advice. Also, we would love somebody followed us already. I'll stop looking at my phone. We would love any sort of questions. So if you send through any questions, that would be great. And finally, if you're over in New Zealand, you can get a copy of our FAP off of our website, morningstar.com.au. And the New Zealand regulatory authorities encourage you to speak to a financial advisor if you want personal advice. All right, so all of that out of the way. A couple other things. We do have 2 additional webinars this week, other than this sort of Tuesday, Thursday time slot at 1 p.m. Sydney time. So we've got one on Thursday night at 6 p.m. And we also have one on Friday at midday. So Thursday night, we're going to talk about, does a good story make a good investment? And then Friday midday, we'll do sort of a post-results season wrap-up with Peter Warrens. So I will, ask him a couple questions, and it'll also give you guys the opportunity to ask him any questions on pretty much anything we cover in Australia and New Zealand, and just general market conditions. All right, so let's get started. So as I said, we're going to talk about ESG today. So ESG stands for environmental, social, and governance. And I've done this one before, and I want to take a little bit of a different take on it today, which is why Shawnee called me an environmental destroying old man. But there has been a lot of debate basically in the industry about sort of the direction ESG is going. And I'm going to take somebody else's viewpoint, who used to be the chief investment officer for ESG at Blackrock, which is the world's largest asset manager. So I'm just going to talk a little bit about an article I read, but we'll get into that in a second. All right. So there we go. The exciting thing is, after this, we are recording our 50th webinar, our 50th podcast episode. So that's exciting. So we have Will in the office today, so I'm not alone, which is nice. Shawnee broke Will's camera while we've been out. So Will is very angry at her. So a lot of intrigue and drama going on. All right, let's talk about ESG and sort of the history of ESG, where we are right now with it, and kind of what's been happening in some of the debate. So traditionally, ESG has been kind of looked at as more of an exclusion list. So basically, you are excluding companies that do things that you do not agree with. And this is really where it started. So it started in the 1970s from religious organizations. So they basically, Quakers and Methodists in the US and the UK decided that they wanted to set up their portfolios that were supporting their religion in a way that adhered to their religion. So basically, how it started was just avoiding alcohol, tobacco, and gambling stocks. So pretty simple. Now, a lot of people still think about ESG in that same way, but it has come a very, very long way. But one thing that is not disputed is that it's very, very popular. So I just pulled a couple of charts. I think everyone knows how popular ESG investing is. But I pulled a couple of charts just so we could talk about this. Okay, so the end of the second quarter in 2021, Morningstar estimates that the number of retail assets, so just assets by everyday investors that are in sustainable investments, was $33 billion. So that's an 18% increase just in that quarter. And it is a 66% increase from the 30th of June, 2020. So in a year. So what does that mean? It means ESG is very popular. So that shouldn't be a surprise. I will say that if we look at ESG assets and flows across different regions, Australia is lagging the US and then in particularly Europe. So Europe is kind of at the forefront of ESG investing in popularity. So unsurprisingly, how do you grow assets? Well, one way, of course, is the assets go up in value, but the other way, of course, is flows. So during the second quarter of this year, $2.9 billion, which is the highest quarterly flow on record, went into ESG, and it topped $1.8 billion, which was the previous record in the fourth quarter of 2020. So it topped it significantly. So in the past year, $7.2 billion have gone in there. Interestingly enough, and we'll talk about this, most of that money's gone into active. So 66% has gone into active strategies. So meaning that there is somebody out there selecting what goes into these funds and ETFs versus, of course, a passive strategy where we are tracking an index, in this case, tracking a ESG index. So this is very different from what's happening overall in the industry, where we're seeing most flows go into passive. So something to think about, and we'll talk about the implications of that in a second. Sorry, this is blurry. Anyway, hopefully you can read it. So where's the money going? Well, there are two really big players in ESG investing in Australia. So Vanguard and Australian Ethical. So you can see that the two of them account for almost 40% of assets. So something to think about in terms of where this stuff is flowing as well. Oh dear. Sorry that people are having frozen screens. That might be a benefit than actually listening to me. But yeah, I think that might be an individual problem. Will's giving me the thumbs up. Probably people are concerned because I talked about the broken camera. It's more of a superficial injury to the camera. At least I think. I don't know. But yeah, Shawnee shouldn't have broken it. All right, so now let's talk about some of the controversies that have happened recently with ESG, because I think this hopefully should be interesting. And what we want to do is we obviously want to have this be a little bit thought-provoking, so you can understand some of the different things going on with this ESG and understand how you want to tilt your own portfolio. So we've got this guy here, Tariq Fancy, and this is who I was talking about. So he used to be the chief investment officer for sustainable investing at Blackrock. And we'll talk a little bit about Blackrock in a second, but Blackrock is the largest asset manager in the world, getting larger and larger probably as we speak. And also, and we'll get into this in a second, also a company that's kind of been at the forefront from an investment standpoint with ESG. So Tariq basically takes this view and he wrote this essay, and the essay is called The Secret Diary of a Sustainable Investor. So it's pretty long, but a really good read and really interesting. And he talks a little bit about his journey at Blackrock. And we've got this first quote where he's basically talking about ESG when he first joined Blackrock, like many of us do. Right? So it is something that allows us to feel good about our investments. Means we're getting two different things. We're getting market return and we get to make the world a better place. Now, sort of what I want to explore today is that true, particularly that second part of it. And once again, this is a guy that's a lot more intelligent than I am, but he questioned a lot of the premises around ESG, and that is not questioning anything else, right? You can still be very much for the environment and social and governance factors. You can be very much supportive of that, but also be a little skeptical around, does ESG investing make the world a better place? So that's what we're going to talk about today. So as I said, traditionally, ESG investing was just excluding certain companies. So whether that's tobacco or alcohol or coal or weapons manufacturing. And, basically what this means is that many investors sort of got this notion that, okay, by not investing in these companies, we are actually making the world a better place. The other thing that people have gotten the notion about between ESG, and a lot of this is kind of going away, but that you are giving up something, like, are you giving up returns? So we can talk about that as well. But let's look at BlackRock for a second. All right, so that's Larry Fink. So Larry Fink is the CEO of BlackRock. So as I said, BlackRock is the world's largest investment manager. So they have about $9.5 trillion US dollars under management. And BlackRock obviously runs a number of different funds, ETFs. iShares is owned by BlackRock, so that's probably where most of us as kind of individual investors come across BlackRock. But yep, that's Larry Fink, and he wrote this famous CEO letter in 2018, which was called A Sense of Purpose. And really what he was talking about is the idea of stakeholder capitalism. So the idea that instead of a company, and this is sort of the original, the Milton Friedman approach to sort of free market capitalism, that a company was designed to maximize profits for shareholders and that anything else was secondary. Well, what Larry was talking about in this very famous letter is he was talking about more of a stakeholder view on capitalism, that companies needed to do more than just make profits. They also need to positively contribute to all sorts of different stakeholders, whether that's their employees, whether that's just people in general. And yeah, and he basically said that if you want BlackRock to back you, invest in you, that you need to follow some of these standards. So this letter, of course, got a lot of attention because of who he is. And there's a lot of reaction from the business world. Much of it, I'd say, fairly positive, and a lot of different approval, or a lot of approval over what he was doing. So this sort of turbocharged this whole ESG journey when he came out with this letter. And subsequently, he has been publishing letters every year, generally along the same theme. So, even his letters as CEO of BlackRock have changed to focus more on ESG. All right. So as part of this whole thing, of course, and I believe that this occurred when this guy, Tariq Fancy, I think it was in his first, right after he started at BlackRock, but he became a little skeptical about the approach. And the reason I want to share this is obviously not to tell anyone what to do, but just to think a little bit about ESG and what it's actually trying to accomplish. So he tells a story in the beginning of his essay, and he's over in Europe, flying around on the BlackRock private jet with Larry and a couple other people, and talking about basically going around with a lot of the salespeople and trying to, of course, sell ESG. And he talks about this conversation he had with a client, and the client asked him, okay, does investing in ESG actually contribute to, for example, fighting climate change? And he talked about this answer he gave in front of the salespeople. And he was saying that, the high growth of these products, ESG products, might, in theory, find some way to indirectly increase financing costs for carbon emitting companies, which could incentivize them to lower emissions. So he got in trouble for this because he was not following the talking points, and the talking points were ESG will change the world. But let's think about some of the different things that are happening with ESG. So what ESG, as it is as it is currently mostly rolled out, is talking about not investing in certain companies. So divestment. So this is basically the idea of divestment, that if you invest in an ESG fund, you are not investing in certain categories. Now, divestment is pretty different from a boycott, for an example. So boycott is what you do as a consumer, right? You will not consume something if you don't believe in, regardless, any aspect of that company or that product. A little bit different than divestment. So divestment means we are not investing in the company. Now, as he said, we can sort of start going down these kind of secondary effects, but is not investing in Whitehaven Coal going to stop coal? Probably not, is his point. And yes, it may potentially increase their costs of funding, which could lower their profits. I don't think you're ever going to get to a point where Whitehaven Coal is going to decide that they're not going to mine coal anymore and switch to something else. That is, in fact, what they do. But this is a point he made, is divestment and boycotts. Do they do anything? The other side of things is, of course, there's something called impact investing. So people sort of moved on from this negative screening where you just screen out certain companies and start thinking about impact investing. So basically what impact investing is you are looking for something that is positive for the environment and you are going to invest in them. So probably the biggest area of impact investing has been something called green bonds. And basically what a green bond is it is a way to finance a product or project that is good for the environment in a cheaper way. So a lot of companies have gone out and got green bonds. So the market size of green bonds, so basically loans to companies, is over $1 trillion at this point. So there's a lot of money in there. Now, the problem is that, as Tariq pointed out, that many companies, these are project-specific companies, that almost every company can find something to finance that fits the criteria to meet a green bond. And it doesn't, of course, impact anything else that they're doing or how they finance anything else. So, this idea of impact investing and kind of, throwing money at certain companies or projects, he doesn't think is that effective either. So the last point is, of course, where we've gotten also with ESG investing in terms of like funds and ETFs, where now what we're doing is we're not just banning things, we're sort of looking at different ESG factors and then sort of ranking companies based on those ESG factors. And that's the way we're going to start tilting portfolios. So this is really what Blackrock has done with a lot of their products, which we'll get to in a second. One of the other problems, of course, is owning a smaller percentage of companies that score lower on ESG, like pollution. So, right, this is where instead of just excluding something that we can like completely exclude, like gambling, for example, if we don't believe in it, we are sort of tilting investments towards companies that hopefully pollute a little less than other companies, but there still is a price, obviously, for what they're doing, environmental price. So this is really where we've gotten with like BlackRock, for example, now in some of their ETFs. The interesting thing about all of this is, of course, if you go and look at a lot of these products, the products charge higher fees to do this tilt. So if you don't really believe that this divestment, and this is even less than a divestment because we're really just talking about allocations, if you don't believe that is going to work, then the question is, will just tilting investments towards companies that do less harm going to benefit anyone? And the one thing I do want to make clear is that Tariq Fancy is clearly an environmentalist and clearly really believes in this stuff. And he's not saying don't do it. He's saying that companies and investing are not the avenue to do it. And instead, we should focus on government action and action that we can do as consumers rather than sort of this ESG tilt, which he really described as something that is very self-serving for a lot of investment companies and self-serving because they charge higher fees. So in a world where fee levels are going down, in a world where funds are going from active to passive, this is an opportunity to get people back into active funds, which we saw on that opening slide that I put out there, and also an opportunity to get higher fee products when we've seen such an erosion. And I went quickly onto Vanguard's website, as they're the largest ESG fund company in Australia. And I just very quickly looked at one of their most popular ETFs, so VAS, so Vanguard Australian Shares, as well as the ASX 300, and then a ethically conscious Australian index that also follows the 300 largest ethically conscious companies in Australia. And for example, Vanguard, who charges almost nothing for any of their products, charged 10 basis points. So that is 0.1%, 10 basis points for this VAS ETF, and then charged 18 basis points for the ethically conscious one. So it is an example, of course, where the fees are higher with some of these specialized products. So just thought I'd throw that out there. Now, 18 basis points is nothing for an investment, but still something to think about. So what are the key questions that we want to talk about today? So as investors, will the amount of money flowing into ESG hurt certain sectors and companies? Is this a supply and demand issue? So this is an issue that we do get a lot. So we were talking about from a divestment standpoint, will flows going into ESG benefit the world or not? I think that's kind of an open question. Is raising the cost of capital slightly for non-ESG companies going to change the world? That's a question for you. But as investors, we need to be concerned with how is this going to impact us. So maybe 10% of the money moving over to ESG will not have an impact on the world, but what it could very easily have an impact on is your returns if you do hold these companies or invest in sectors that are not ESG friendly. So actually the podcast that we're recording after this, we're looking at I believe a beta shares ethically tilted ETF. And when you go through and you look at allocations to sectors, as you would expect, there's almost no allocation to resources. There is zero in energy as we kind of go sector by sector through there. So is that tilt going to hurt you as an investor? So it's something we do need to think about, and something you need to think about, obviously, with your own funds, that even if you're not trying to save the world, are your returns going to be hurt as demand for those shares and certain sectors goes down? And I think it's something really important to think about here in Australia, because obviously if you sit there and look at the composition of the Australian indexes, a large part of it, so something close to 18%, is in basic materials, right? So those are the miners. So we've seen some moves recently. So BHP sort of getting rid of their oil and gas assets. We've seen some moves as companies have tried to position themselves to not get excluded from some of these ESG funds. But how will that impact us as investors in Australia, where so much of the index is made up of basic materials companies? So, once again, if I'm BHP and I am sitting there and I am shipping, if you go look at the price, so what is it, like $220 for a ton of iron ore? There is certainly environmental costs for digging this stuff up and shipping it around the world when you're making very little money for a ton of it. There are some, obviously, implications of that. So is that going to hurt us as Australian investors who are invested in the local market? So something to think about. The other thing to think about is ESG risks, and kind of how we think about it in Australia is there's another way to think about it, that an ESG risk to a company is simply just another risk. And as investors, it's pretty simple. We want to sit there and we want to look at the risks associated with companies, and we want to make sure that we are adequately compensated for taking on those risks. That's at the heart of all investing, right? Why do we invest in shares? We invest in shares because we have a higher expected return because we are taking on more risk. So the idea about investing, of course, is you take on risk so that you can get higher returns. And you just need to make sure you're compensated for that risk. So traditionally, the way that investment analysts have looked at companies is they have looked at all sorts of different risks, but have not looked at ESG risks. And so, our argument here at Morningstar is we want to incorporate this into our research, but that does not mean that you wouldn't necessarily buy a company that did not meet ESG standards, obviously depending upon yourself and sort of what you're trying to do with your investments. What it does mean is that we would make sure that we are adequately compensated for taking on that risk. And the example that I always use, because there's some obvious risks, but the example I always use is, talking to one of our analysts who used to cover Coca-Cola, and Coca-Cola obviously uses a lot of water, as you would imagine, to create Coke. And, this analyst who's pretty thoughtful about this stuff was telling me that, now that we started talking about ESG, he was thinking back to when he covered Coke, and that, if he did not take, some of the things that are happening with water and the scarcity of water in a lot of parts of the world now, and sort of the expectation that that will continue to become more scarce, if he did not take that into account as a risk to Coca-Cola, he wouldn't be a very good analyst. So that's what we need to think about. I don't know why that says friends. Non-ESG friends. Yeah, sorry. I apparently can't speak English or type. But anyway, we're just making sure that that ESG risks are incorporated into different investment decisions we make. And then kind of the last thing is if we are passive investors, and this is where we're going to look at those price differentials between different products. Does, over the long run, if we are investing in a market cap weighted index, meaning the biggest companies would represent more of the index, these shifts, if we're passive investors, these sort of shifts into ESG, how much is that going to impact us in a market cap weighted world? So that's kind of what I was talking about above with different sectors and different companies, but something to look out for. And anyway, thanks for listening to me talk about ESG. We've got, on Thursday, we'll talk about investment strategies and how to implement them. Then at night, we'll talk about does a good story make a good investment, which you could say maybe ESG plays into that. And then finally, we have that webinar on Friday with Peter Warrens. So go stump him, ask him about ESG. That's what Will wanted before, to hear Warrens' view on ESG. But anyway, thank you guys for joining.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.